It's the interview series. The interview series. It's the interview series. It's the interview series. But
all right, welcome to the interview series. I'm really excited to introduce Stephen Houghton, CPA. Welcome to the podcast, my friend.
Thanks, Jeff.
It's
glad to be here.
Great to see you.
Absolutely.
Normally I'm at your office,
and
we're talking about taxes. So welcome to my office.
Your office is much better than my office.
I love it. Hey.
Yeah, it's a good place.
An office nonetheless. So real fast, you're born and raised in Santa Rosa, California. Eagle Scout, team captain of the high school tennis team. Graduated from Utah State University with 3 bachelor degrees, marketing, economics, and accounting. Graduated from Utah State with 3 bachelor degrees, marketing, economics, and accounting. That's amazing.
Yeah, so most people go into college and they they get in and they decide later they want to back out or do something else. And I'm the same way. It's just I wanted to accomplish each goal. So I went, I finished it, and then I went and I went. So
wow.
That's how I got 3.
It doesn't say it here. You're obviously CPA. I'm going to finish this. Have 2 children, ages 10 and 8, so you're busy. Enjoy, camping with the family. Recently got into barbecue and smoking meats.
Yeah.
I love food, so that sounds amazing to me. Back to the, how long did it take you to do those 3 bachelor degrees?
Well, only 5 years. So Utah State has a nice program where you can easily double major so there's the College of Business, and you can easily double major. So I actually double majored with economics and marketing. So I got 2 different degrees at the same time. So that was really nice. And then I took about a year off. I was trying to figure out, where it was 2009. I mean, we don't need to get in the boring recession of 2009, but it wasn't the best time to graduate college.
Yeah.
So that's when my father, who's a CPA, said, I know CPA is not your first pick, but it's a great business. Why don't you come take it over? So then I went back to Utah State, and at that point I'd had all my College of Business classes done, so it was just 1 more year. So it was really 5 years.
So I'm just going to back this up for me, right?
Yeah.
So 5 years, 3 degrees.
3 degrees, 5 years.
They do say comparison is a thief of joy, but I'm going to do this anyways. It took me 5.5 years, and I majored in 1, so more power to you.
Yes, it was a good setup. I pretty much took every class of the College of Business, just bam. So
that's amazing, man.
Yeah.
That's amazing. So at least we know that, we're talking to someone that's really putting to work, man. That's amazing. So I love it. So you're down to just dive into this thing?
I'm ready to go.
Let's go.
Let's do it.
Obviously, as a realtor, I want to make sure that my clients are taken care of. I'm showing homes. I'm helping them sell their homes. I mean, all that good stuff. I've talked to lenders, financial advisors, escrow officers. I mean, there's a team of people to essentially help, the common consumer out there. And so I think the next person is you, right? So the tax guy, CPA, and but as a consumer that wants to purchase, a home or even extend their portfolio from a real estate perspective, what are the benefits of having a tax professional such as yourself?
Sure. So in the world of CPA, there's a lot, just like in the medical profession, there's a million types of doctors. Well, accounting, there's tax, there's audit, there's bookkeeping. So we focus on tax. I'm going to give a lot of tax answers today. A tax CPA is really valuable for anyone who starts a business, anyone who gets a rental property. I think that's when you want to step up and start seeing a CPA. If you're a W-2 and you buy a house, so you start to itemize your deduction. I get a lot of calls from people saying, "Hey, I bought a house, I need a CPA." Sure, you can still do it on TurboTax. So if you're a W-2, you own a home, you can probably do it on TurboTax unless you don't want to deal with it. Of course, we're there for you. But the minute you step in and you buy a second home and you rent it, you're probably better off as seeing a CPA. I can't tell you how many times I get a call from people who do it themselves. They always get depreciation wrong on the house. It's complicated. Our tax code is way too complicated. And if you want to get it done right, you better see a tax professional at that point.
Yeah. I love that. I think one would think that a CPA would answer that question as come see me, I can help, as opposed, and you're saying, well, there are parts of this you can do yourself.
So TurboTax is powerful.
Yeah.
It's awesome. Another comment, cost. I mean, I'm a frugal guy. I'm a cheap, frugal guy, right?
Yeah.
And I look at the cost. And so TurboTax, there's some free options I don't even know. I know the basic TurboTax costs about $100. If you're going to do the business TurboTax, it's about $300. So if you look at it in terms of cost, well, you know, our basic return we charge $500. So 500 compared to 100, and there's a $400 difference. But you know, we do stuff for you. But the minute you start getting into the business world, you know, we might charge $600 or $700 for a business return, but TurboTax is going to charge you $300. So it's still just a $400 difference. So I think from cost, it makes a lot of sense to see a CPA when these tax softwares cost so much money.
I love it. What tips do you have? I mean, I think that's when someone sits with you, immediately they want you to help and add value to them. And so what tips do you have for individuals or businesses that are looking to manage their finances better?
Basic. I mean, I'm a basic guy. Anyone who has a business, I always ask, are you a credit card person or are you a debit card person? Because I don't care. I'm not going to say you should be debit card or credit card. I don't go into that stuff. Each have their pros and cons. But you should have two cards. One should be your business card, one should be your personal card. This spiel of mine lines better if you're self-employed than if you're just a regular W-2 person. But you should run all of your business expenses on one card. It keeps it clean, it keeps it separate. The IRS doesn't require you to do that, it just keeps it clean. So I would recommend keeping all business expenses separate from personal, just with two credit cards. You could even put a sticker on your card. Every time you open your wallet, how often do you open your wallet? Every day. You're going to the store, you're on Amazon, you're buying something. It's the moment that you go to the checkout that you should open up your wallet and say, which card am I going to use? It's at that moment you make the decision, because then it hits the credit card statement, you pick it up, you put it on your tax return, and you're good to go.
I love that advice. I do have a question that I probably have asked you before, but I'm asked it again.
Yeah.
And it might be a common question that you get. When you do have two separate cards, I think everyone thinks you have to keep the receipt. Is that something that you still have to do?
All right, good, better, best. All right. Worst is you don't have a receipt, you don't have a credit card, you pay with cash. I mean, paying with cash is terrible. The IRS doesn't accept cash. But if you pay something with cash and you come into an audit and you say, I bought this on this date with cash, sometimes they accept that, believe it or not. Better, of course, would be a credit card. If you have a credit card statement, you come in an IRS audit and you give them your credit card statement, you highlight all your expenses, they almost always accept that. Of course, best is a receipt. The IRS will accept the receipt. So, you know, good, better, best. Best is the receipt. But if you got a good credit card statement, that passes almost all your audits. So you don't really need the receipts.
Okay. What would you say, out of all the difficult tax-related situations, what's the most difficult tax-related situation you've ever had to get someone out of?
Yeah, I mean the most. It's hard to say the most. The one came to mind. This was years ago. I had a client come to me, and they said, "Hey, our CPA said that we have to pay tax on there's a concept called cancellation of debt. I don't need to get in the weeds. People don't want you to learn about the tax code. If you have cancellation of debt, you have to pay income on that. So what is cancellation of debt? If you have a credit card, you rack up $40,000 and you walk away, you'll get hit with a cancellation of debt 1099. You have to pay tax on that because maybe you went on a $40,000 trip to Hawaii. Well, you got the benefit of Hawaii, so the government sees that as income. I actually see that too. If you go to Hawaii, you spend the money, that's income to you. So it's called cancellation of debt income. Well, there are ways of getting out of cancellation of debt income, and their CPA told them you couldn't get out of it. So they came to me as a second opinion, we're talking hundreds of thousands of dollars. So they said, "What do you think?" And I said, "Well, yeah, you can get out of this cancellation of debt." It had to do with real estate. So they had property. It was the downturn of the economy, 2010. They bought the house for here. The house was now worth down here. They walked away. So they had all that cancellation of debt on that mortgage. Question is, can we get out of it? Well, there are special rules of getting out of real estate cancellation of debt. I told them how they could do it. We amended their return. I saved them a few $100,000 of tax. Then they got audited on it, and we had to defend it to the IRS. So we had to face the IRS with it. Not only that, they had about 1031 exchange from the last 20 years. The IRS went back to the prior 15 years in that audit and audited all those 1031 exchanges. So we had to defend the 1031s from prior years, and the cancellation of debt. And
Wow.
we got through it, a couple $100,000.
Wow.
That was pretty cool.
How long did that take?
That process, I mean, but you know, the audit itself was a multi-month audit, yeah, because they kept coming back.
Did you guys
Yeah.
get it done in that year?
Yeah.
It never rolled it the next year?
No, just the 1 year.
That
One year got audited,
Okay.
but saved him a lot of money.
Wow.
Yeah.
That's awesome.
But there's other stuff. I mean, that's one that stands out. That was we got him money. The other CPA wouldn't have done it, and we got it for him.
Was that like your Tiger Woods moment?
That
where you're
was. I was like, I'm here. I've arrived. That's right.
I love it. With that, I know you've seen a lot of different issues, crazy stories out there. But what would you say is the biggest mistake that you see? I guess more. How do I ask this question? What would you say is the biggest financial mistake that you see people have?
Yeah. Again, basic, right?
Mm-hmm.
Debt. There's a phrase, probably the internet knows it better than I, but those who understand interest earn it. Those who don't understand interest pay it. I love it. So getting into debt's easy. It kind of sickens me every time I see financing for a furniture store. It's like, I mean, I don't know. I mean, it all comes, who are you, where are you? It's easy to judge. I mean, if someone's hard on times and they're into debt, but debt's a killer. So I would say debt. I'd say getting behind on taxes. We're going to probably talk about that here a little bit later. Getting behind on taxes. So if you're a brand new business, you're a real estate agent, first time ever, and you sell some houses and you have commissions and you make money. If you haven't set aside money for taxes, getting in that hole and then digging out of it can be really tough. So that's another big one. I got one more comment on this question, if that's okay.
Please.
Okay. I thought, do I want to go here today? And I do want to go here. It's the best advice I've ever got. I have an 85-year-old client. He's worth $15, $20 million. I'm like, give me some advice. What's some good advice for me so that I can become you down the road? And he said two things. He said, number one, well, I'm going to say it nicer than he said. He said, don't get divorced. But I'm going to say it nicer. Know that when you're getting into a marriage, you're entering into the most important legal contract you're ever going to enter into. Financially, it can be devastating to go through a divorce. So that's number one. Be careful about divorce. Number two, and I love this, and maybe not all real estate agents are going to hear this, never sell real estate. Never sell. Now, if you're a real estate agent and you specialize in selling real estate, you want your clients to sell. I tell clients never sell. Buy real estate. I love real estate. We'll talk about real estate. Buy, never sell. So there you go. There's my little spiel.
I love it. My second question, what are some ways to make sure that we can alleviate those mistakes? But you broke it down. I love that. Can you go back and say it again? I just want to hear it out of your mouth.
Yeah.
The interest one.
Yeah. Those who understand interest earn it. Those who don't understand interest spend it.
That's amazing. I love that. I don't think I've ever heard. I'm a quote guy. I listen to a lot of financial stuff. I mean, years worth. I've never heard that one. That's really awesome. I love that. What are some changes you've seen in the accounting and tax landscape over the last few years?
Yeah.
Right? Especially, I guess, in the last few years, I'm thinking, with COVID, that whole thing. I'm sure there's been some changes. So what have you seen out there?
It's been wild. It's been a wild couple of years. Specifically, Northern California, Santa Rosa. I don't know, where the audience is from, but we had the fires in 2017. We're still dealing with that, by the way. PG&E money's coming through, so we're dealing with PG&E fire settlements, and we're going to be dealing with that for another number of years. So this is still happening. Then the pandemic of 2019, huge changes. There was the PPP program, and all these businesses got PPP loans. Well, now, at the same time, there was the employee retention credit, ERC. You hear commercials on the radio. Hey, come get your ERC. So the ERC, employee retention credit, very valuable, and the expiration to file for it is actually coming up because you have to amend your 941s. I'm getting into the weeds here. The expiration's coming up in a few months. So there's big credits out there. They exist. With the pandemic, I don't know how much the government spent. Was it $2 trillion, $4 trillion? I mean, I lost count. I lost count of how many trillions it was. I don't even know what $1 trillion is really. But there's a lot of money out there, and so even on a regular return with a child, The child tax credit changed. You got advance payments of the child tax credit. So if you have a kid, you got advance payments. That was last year. That's all ended now, so that's all done. So going back to your question, what's changed? It was chaos for the last few years. It's been chaos, and I seek sympathy from clients, so I seek sympathy from your audience. If you get frustrated with a tax professional, it's been hard to keep up with all this stuff. This year, coming into 2022, no big changes. So the advanced child tax credit for the pandemic, that's all gone. It's all gone. No more stimulus, no more child tax credit. There's still a bit of time for the ERC, and then we're all done with the pandemic.
Love it. Love it. Any additional financial planning tips you have to kind of manage your money or from a tax perspective?
Well, I want to go back to, and this might be a question for later.
Yeah.
You know, how to save for taxes. Now, if you're a W-2, your taxes are withheld. I don't know. You get a refund of $1,000, or you owe a couple thousand, or I don't know. Or you're a doctor and you owe $20,000 because the withholding was off. Sorry, sorry, doctors. I admire you, by the way. I wish I was one. If you're self-employed, you got to handle. You don't earn the. You got to handle the money, I think, in multiple layers, right? I'm going to use me as an example. I'm a corporation. I have a partner, a 50-50 partner. We let the business accumulate all this money, and we pay ourselves just a very little bit throughout the year, just enough to kind of cover our expenses. So when I pay my taxes, and I write checks to the government, I write my own checks, I pay my own taxes. I do that from the pot from the business, and I grab the money and I pay my taxes. So I don't really earn all my money from the business till the very end of the year, after I've paid my taxes. Now, that's me, I'm a corporation, that's how I do it as a partnership. But going back to just a regular real estate agent, the great advice is set aside 30% of your commission check. That's great. Same thing. It's the same concept. You got these earnings from your commissions, they should be in this pot. You should pay your taxes from that pot, 30%, and then take the rest as your earnings. So that's just staying ahead on your taxes.
I love it. It's good info. I don't know how many people are actually, coming and seeing an actual tax professional and doing it the right way. So any insight you have, I think is definitely good. You mentioned earlier, I want to go back to, you said, I guess there's tax implications on selling a house. Like, what are the tax implications of selling a home?
Yeah. The first thing you got to break down is it a personal home or is it a business home? Is it the home you live in or is it a rental property? Those are kind of the two basics. I mean, obviously there's a million different ways to break down a house. Taxes are very different. If it's your main home, there's a special rule called the principal residence exclusion. Every real estate agent knows it. You get to exclude $250,000 of your gain on your primary home that you sell. And if it's a married couple, it's $500,000. It's really, really powerful. You need to know about it. Everybody knows about it. So that's a powerful way to help reduce your taxes or your gain on your home. With a rental, when you sell a rental, taxes are huge. They can be really big. So basically, what'd you buy the rental for? What'd you sell the rental for? And you're going to pay tax on the difference, and the tax is going to be pretty high, pretty substantial.
Got it. So there's been questions that have been asked, and obviously I refer them to the specialist, right, which is you, right? From a capital gains perspective, one, what are capital gains?
Okay.
And then two, how are they calculated?
Okay, let's start basics, right? I think everybody understands what a stock is. You buy a stock for $5, you sell it for $10, you got a gain of $5. That would be a capital gain. There's long-term and short-term. So short-term is anything under a year. Long-term is anything over a year. Long-term capital gains are taxed lower than regular income. So that's why it matters. Capital gains are taxed a little bit less than ordinary income. So there's a lot of court cases, a lot of arguing. What is a capital gain? How can I make it a long-term capital gain versus ordinary income? Because there's the tax advantage of making a long-term capital gain. So going back to real estate, if you own the property for more than a year and you sell it, and there's a gain, it's a long-term capital gain, and it's taxed less than ordinary income.
Okay. It's a good breakdown. I love it. In your experience, what should the average person know about a 1031 exchange?
Yeah, so 1031 exchange, they've been around for, I don't know, decades. I don't know when they started. The concept of a 1031 is, hey, I bought a property. I want to sell it and I want to buy another property, but man, if I have to pay all the tax, I'm not going to be able to afford to buy the next property. So decades ago, the government said, all right, 1031 exchange. Section 1031, that's a code section, 1031. You're allowed to sell your property, buy another one without having to pay the tax. That way you can afford to pay the next property. That's the whole concept behind it. 1031 exchange are very valuable. They're very important. Back in 2017, there was the big tax overhaul under President Trump, and the government proposed getting rid of 1031 exchanges. That would have upended the real estate industry. They were able to keep them. Code section 1031 did change a lot. You used to be able to 1031 exchange tractors and equipment. You can't do that anymore. It's only rental real estate. So it's very limited, rental real estate. You sell a property, you buy another property, and you don't pay the tax. That's what it is, in summary.
And then obviously, outside of that, just seek a professional for that, obviously.
Yeah, if you do it, you have to use a 1031 accommodator.
Exactly.
You must use one. So my advice to anyone doing it is have a real estate agent who deals with it and have a 1031 accommodator from the very beginning.
Okay. Are there any real estate strategies that you would suggest anyone partake in or no?
Yeah, just again, going back to basics. Something I will tell the audience, our clients, we're from Santa Rosa, California. We're the North Bay. We're not Silicon Valley. So our clients don't specialize in startups. They don't specialize in making millions in the stock market. We're not Warren Buffett type people in the stock market. Our clients have made all their money in real estate. So we're very biased towards real estate. We love real estate. The North Bay real estate has doubled every 10 years. It at a zero every 30 years. That's kind of that's how much real estate increases over time. So going back to your question, the basic answer is you buy, and pretty soon you're 85 years old. You don't want to be 85, by the way, because you're dead a couple years from now. But the next thing you know, you're 85 and you're worth $20 million, and it's because you bought and you bought and you bought and you bought. So now if I can go a little further, am I?
No, please.
Boring people.
Dive
okay.
in.
Dive in a little further.
When I'm quiet, I'm listening.
It's harder now than it was 60 years ago. There's no more secret of real estate. How many millions of books are there? How many online YouTube channels are on there that talk about buying real estate? There's no more secret. I think 60 years ago it was a big secret. So going back to this 85-year-old client of mine, he bought his first investment property when he was 19 years old, and he did it with zero down. Zero down at 19. And his cash flow was break even from day one. So his rent covered his mortgage with zero down. Well, nowadays, you're not allowed to buy with zero down, so can't even do it. And you can only buy with 25% if it's an investment property. So you have to put 25% down. You're lucky to break even with cash flow with 25% down. So the reason I say that is it's harder now than it was 60 years ago. So I'm sorry to the world. It's the world we live in. But still, I think the concept of buying and buying and buying holds true. Maybe we can only end up with 3 or 4 houses instead of 20 like these other people, but at least we got 3 or 4.
Yeah. Shout out to the vets, and thank you for your service. I think that's the VA loans are the only option that allows us to do the 0%.
You might know better.
Loans.
Yeah, sure. I don't know.
Right, so
I'm
there's
not
a
a
few
mortgage
options
guy
out there, but
I'm not a mortgage guy.
But you're right. And those that even if you do it, the math doesn't even make sense to break even if you are doing that.
Yeah.
But yes, any tax planning strategies, any additional tax planning strategies that people should be aware of or consider? There's specialty credits. If you hear stuff, I would say go ask your tax professional. Another good reason to have a tax professional, you can always bounce ideas off them. I welcome emails and phone calls. So, do I get vehicle credits, for example? They've changed this year. Can you get a vehicle credit?
solar credits, putting on solar for your house. So there's credits available. You might want to try to hear about them or Google them and ask your tax professional. But again, going back to the basics, anyone with a business, and I'm sorry for you W-2 people, there's not a lot you can do with your taxes if you're a W-2, so I apologize to you. But if you're self-employed, you just want to be aggressive. And I got to be careful with my words. I don't know how many IRS agents are in your audience today. And they might just be hearing what I'm saying and just shaking their head and they want to attack me. So, but you want to be aggressive. I think you don't want to cheat, but you want to be aggressive on saying what's a business expense. And the reason I say that is because you deduct it, you save on the tax. As long as you feel you can ethically go into an IRS audit and say this is business related, I encourage people to write it off. So my answer is write stuff off.
Okay.
Be aggressive.
Okay. You've mentioned it several times, but I have to ask just the actual question, even though you kind of hit on it several times. Like, what are the best ways to save money on taxes?
So deducting as much as you can in your business, writing stuff off. If you're selling real estate, taking advantage of a 1031 exchange. I forgot to talk about options of 1031s. I might want to do that more, but doing a 1031 exchange, knowing if you're going to sell, how to sell, when to sell. There's a concept about, we talked a little bit about capital gains. You can strategize with your capital gains. And capital gains have a lot of rules. So if you're going to sell something like a stock or a piece of property, the question becomes, well, do you have another stock or a piece of property that you can sell that has losses? So maybe you can use those losses to go against the gains. So anytime you're going to sell something, you might want to think about what do you have, what do you own, and talk to a tax professional to say, when can I save tax on this? So anytime you're going to sell something, think about the tax consequences.
Okay. And then what if you're a W-2 and then you also have like your side hustle would be something that's more business related? Like, how does that impact taxes?
Yeah.
I mean, W-2, you're saying, this entire
you can't
time,
do a whole
not
lot.
much you can do.
Can't do a lot.
If you have like something that's,
yeah.
not that they're doing like an Uber Eats, but something, let's just say they're starting to sell some stuff or whatever that case.
They're starting a walnut farm.
Exactly.
I got them.
Okay.
Or a pig farm.
Exactly.
I got them. Yeah. There's rules on that stuff.
Yeah.
So if you're a W-2 and you're a doctor, you make $500,000 and you want to start a pig farm, and you want to spend $50,000 on your pig farm and write it off and have that go against your $500,000 of income. Well, so if the pig farm is a business, you're allowed to write it off. But if the pig farm is a hobby, you're not allowed to write it off. So it's called the hobby loss rules. There's rules on all that stuff. I tend to tell clients, you can dabble in that for a year or two, but the minute you start hitting year 3, 4, 5, you will be audited. Not if, but when. And when you got audited, the IRS will disallow it. So you're allowed to be a W-2. You're allowed to have business losses, but you got to be careful. And you're a big red target, big red flag.
What is the difference between a hobby and a business?
Yeah, there's no black. I mean, with that, there's no black and white answer. There's a test. Do you have a profit? Are you living on the money? What's your intention? Are you keeping records? Are you running it like a business? So if you say you form a corporation, well, that makes it look more like a business. Does it kind of smell like a hobby? I mean, is it horses? The IRS doesn't like horses, by the way. So is it horses? Is it animals? Is it stamp collecting? But let's seriously say that let's say you are a doctor and you're I'm going to be politically correct here. The wife is a doctor who makes $500,000, and the husband doesn't have a job, and he starts something. I mean, sure, he's allowed to try to start something, So you're allowed to have a business, and you're allowed to have losses, and the IRS just takes all of the facts and circumstances into account. My answer is you can get away with it for a year or two. And if it's 3 or 4 or 5 years loss, you're in trouble.
Got it. Got it. What were you trying to circle back to as it relates to 1031s?
Oh, I want to talk about an investment strategy that people might not know about. So the problem with 1031 exchanges, they're not flexible. You only have 45 days once you sell your property, you only have 45 days to identify what you're going to buy. Only 45 days, that's not very long. And then you have 180 days to actually close on that property. So very, very strict time constraints. So there's something called a Delaware Statutory Trust, DST, and you can invest your money into that, and that counts for a 1031 exchange. So you don't have to do an actual rental property. It could be a DST. A DST invests in rental properties, so you're able to do a 1031 exchange through a DST, and it just adds flexibility. You're not involved. You say, "Here's my money. Here's $300,000," and you go throw it in a DST. Trust. It's not a fund. It's a trust. Your money's over there. You don't manage it. Your money's in a piece of real estate, and you don't manage it or anything. So it's just very flexible. It's a way that you can do a 1031 if you really have a problem with time.
Got it. That's good feedback. What else do the people need to know about taxes? I think I probably could have asked this earlier, but when they first sit down with you, is there anything that you kind of walk them through? Anything that you set expectations for? Like what else do they need to know? Like what's for the common or average person out there that's thinking about calling you? Even though I know you're busy, you're kind of booked out, but at the same time.
Yeah, we are taking on clients, but there's a lot of demand, which is great. Demand is good.
For sure. So what else do you tell them? Like what other information do you let them know?
Boy, where do I go with that? What comes to mind right now, this might not even answer your question. So
it's okay.
The phrase, pigs get fat, hogs get slaughtered, comes to my mind. So what do I mean by that? When it comes to taxes, people come to me all the time. They say, I just want to save on taxes. And sometimes they come give me concepts on ways to save taxes. And they're often unethical or kind of pushing it too hard. So pigs get fat, hogs get slaughtered. Be a pig, don't be a hog. So I think being a pig is being aggressive on your deductions and writing stuff off. A hog is when you start pushing it, just being over the top. Writing off, a pig farm that you shouldn't be writing off. That would be, there's my analogy of your pig and hog. Sorry for the pun. I think people often come to me, they want to save tax, and they're so focused on wanting to save tax that they miss the forest from the trees. I'll give you an example. I have a doctor who I've referenced. It's actually a dentist, so I'll go with a dentist. I have a dentist. He makes a lot of money. He does really well. He's successful, and focused on retirement plans, because we haven't even talked about retirement plans. 401ks, IRAs, Roth IRAs. These are all vehicles the government sets up so you can save money. So you can save money on tax and save money towards retirement. Great. It's good that they exist. But I don't care about them that much. I mean, they're there. I'm happy if a client does them. But people get so focused on, I want to maximize a Roth, and then I want to do a traditional, and I want to do a 401k, and I want to have all of my retirement plans, and I want to get them all maxed out. And my answer is, well, why don't you just go buy another house? Don't focus on the tax. Focus on what's a good investment. What makes me happy? Should I go on a vacation this year? Should I buy another rental property this year? Am I already worth $15 million? Do I need a 16th million? Should I go on vacation? So I'm coming back to, where am I going with all this? People come to me, they want to save money on tax, and I don't think that should be your number one goal. Even with a tax professional, that shouldn't be your overall number one goal. Having a well-rounded life, saving your money, buying another piece of property, buying a stock, going on vacation, those should be the focuses of your life.
I love it.
Not saving tax.
I love it. Ironic to hear that from a tax professional, but also good. I mean, simplistic. I think you would probably take the same advice, right?
Yeah.
In your own life,
absolutely.
Right?
Yes.
You're just like, I see all these taxes. Go live your life. Go do your thing. Right?
That's right.
I love it. So obviously, Houghton and Houghton is the name of the
Houghton. Yeah.
Houghton and Houghton.
George Houghton was my father. I will give him credit. I should, I should take props to myself, but my dad started the good business in 1978 here in Santa Rosa. He retired about 3 years ago, and it's my brother and I, Houghton and Houghton.
Awesome. And it's 1978. Okay, gotcha. And it's obviously down. Where can they find you? Obviously.
So we're on the internet, but we don't have a strong internet. But we have a website. If you Google Houghton and Houghton CPAs in Santa Rosa, we'll pop up on Google. We have a website. We made it ourselves. Actually, my sister made the website. So it's probably not the fanciest thing you've ever seen, but it has our name, contact information, and we're happy to take your phone call. Happy to take clients on.
Love it. Well, I have to ask, what is your dad doing now that he's retired?
You could have a whole podcast on it. My dad's fascinating.
Yeah.
He loves woodworking, so he does bowls. He turns wood bowls and wood vases, and he's dabbling into physics. So he's not he's a CPA, but he's getting into physics, gravity, and he's written a paper on gravity, and he's gotten it published.
Wow.
So he's got a theory on gravity.
That's awesome. It seems like he's kind of transitioning. He's still working.
Oh yeah, he's staying busy.
He's staying busy.
He's staying busy. Just not with tax. He's done with tax.
I love it.
Yeah.
I love it. That's awesome, man. I appreciate it. Thanks for your time today.
Yeah,
I really
absolutely.
do. Yeah.
Thanks for having me.
Wealth of knowledge, man. Appreciate
Yeah.
it. Thank you so
Okay,
much.
Jeff. Yeah, absolutely. Take care.
You as well.